Well, hi everyone, this is Wayne from inventoryschools.com. Welcome to Inventory Management in 3 minutes on the topic inventory measures. One of the classic kind of quotes that you often see is, you can't manage what you don't measure. And this is so true for the area of inventory management. It's a must-do if you're managing inventory. So what are some of the measures that you could use? Now I'll explain inventory turns and days inventory outstanding in a little bit more detail in the subsequent slides, so just bear with me for now. Firstly, you must measure inventory turns and split them up into the ABC classifications of your inventory. You can also calculate inventory turns by categories, so calculate them for raw materials, work in progress and finished goods. You can also calculate days inventory outstanding by ABC classification as well, and calculate them into the categories of raw material, work in progress and finished goods. The other major one that you must be doing is slow moving and obsolete. This is where you might say, if we haven't sold an item or used an item for 6 months, we'll define it as slow moving. If we haven't sold it or used it for 12 months, we'll define it as obsolete. And you need to measure and calculate the dollar value of inventory in those categories and just keep track of that. Very, very important. The other one is gross margin return on inventory investment. Now, we all know that there's a cost to holding inventory, and this calculation helps you see if the inventory that you've got is really earning its keep. And it does that by comparing gross margin with inventory cost, and it comes up with a ratio. And if the ratio is greater than 1, it says, no, it's okay, that inventory is pulling its weight, it's worth having it for the gross margin that you're earning. But if it's less than 1, you better have a look at it. So the gross margin return on investment is really a great way of identifying items that you might need to derange. Now the Dupont model is a visual view of your organisation's finances, which calculates return on assets, which is really quite simply just a ratio between your net profit that you've made and your asset turnover. Now asset turnover involves inventory. Now as inventory managers, you're able therefore to demonstrate the benefit of reducing inventory and the impact, the positive impact it has on the return on assets. And if you want a measure that will catch the eyes of your CEO, then talk about return on assets and how you can influence by reducing inventory. So just another good measure to demonstrate the importance of inventory management. So what are a couple of definitions? Now inventory turns, this is the classic one. It's the annual cost of goods sold divided by the average inventory level. An example would be if your annual cost of goods sold was $150 million and your average inventory level was 50 million, therefore your inventory turns is 3. So it's just a number. It could be 3, 4, 5, 6. The bigger the better. And what you have to do is just measure those in your business and see that month by month, quarter by quarter, those numbers get larger. Now there's some debate sometimes. It is the annual cost of goods sold and the average inventory level. Some companies might use the inventory level at the end of year. Now that might not be representative of the average inventory level over the year. So just need to be a little bit careful about what figures you use there, especially if you're comparing with other companies. Days inventory outstanding is fairly simple. It's 365 divided by inventory turns. So if you have an inventory turns of 3, your days inventory outstanding will be 122 days. And the way you read that is for this item you'd have 122 days of stock at your average sales rate. How good are you at inventory turns? Well, there's a lot of published data about what companies are achieving. Here's one from the Gartner Group in 2010. And it lists the amongst other things, the inventory turns that these companies have. More particularly, if you go to our website at inventoryschools.com and go to any one of these pages, you'll see an opportunity for you to compare yourself with the world's best. So click on there. You can add your own annual cost of goods sold and your average inventory level. It will calculate your inventory turns, it will calculate your days inventory outstanding, and it will compare yourself with some of the better companies in the world. So please avail yourself of that feature. It's one thing to work on measuring inventory, it's another thing to improve it. So here are some skills that you should have throughout your whole organization for it to work properly. You must understand what the ABC inventory classification process is all about. You must understand the reorder point. It sounds simple, but there is some theory behind it, especially safety stock calculations, so you must have that well understood in your organization. Periodic review is another replenishment technique, looking at replenishing inventory on a regular period rather than using something like reorder point. Improving inventory accuracy, absolutely important if you're going to manage inventory well. Cycle counting is another tool that you might use to improve inventory accuracy and fix root causes. And of course you must measure. Now finally, if you want to know more information about these topics for additional articles, videos and spreadsheets, please visit us on inventoryskills.com. And remember, with new skills, you'll stand out.